What up, nerds? My name is Luke. I help people interested in crypto get some returns on their savings through the power of DeFi. So today I'm going to do a little follow-up to the video I did on building a DeFi portfolio for my dad. And this is the idea of building a portfolio from scratch and doing all the kind of analysis and investments and different things that we can include to build this portfolio. So this series is probably going to take me quite a while. I'm going to take my time with it, no rush. So don't expect further videos and a completion of this series. We're going to do it step by step. So today I'm going to look at Polygon, and this is all the protocols that could potentially generate a market neutral yield on the Polygon chain, and I'm doing a bit of a shallow investment analysis. So that's mostly just looking through what options there are, what kind of offerings they have, what kind of yield it is, how they generate the yield, the approximate returns, and trying to go from a long list of potential protocols to investigate into a short list. And once we have the shortlist, then you can do some real deep analysis on each one, on each offering, inside each protocol, and try and decide if there's any good, profitable investments that can be made and how they fit into the greater portfolio. So let's get started. So the types of investments I'll be looking at hopefully will be ones that I would put into the defensive investment allocation of portfolio. So these ideally would be ones that have returns and risks associated that are uncorrelated to market risks. And what I mean by that is the market is the greater market, of course, but mostly the Bitcoin, Ethereum, and kind of crypto price market. So we want returns and risks that basically that won't happen at the same time. So if Bitcoin crashes, we don't necessarily want now our defensive assets crash at the same time, because then they wouldn't be classed as defensive. So this is all basically things that are either stable coins that are uncorrelated to market returns, or different types of yield generation, delta neutral yield generation, or, well, not necessarily delta neutral, but ones that are related to lending, and different things that where the risks are more related to protocol specific risks, hack risks, bugs, chain risks, etc., which would be, in my opinion, mostly uncorrelated from the market. So how we're going to find this list is we're going to go to DeFi Llama. If you haven't gone to DeFi Llama before, it's a great resource, and you can find every protocol, different kind of statistics associated with them, the links to the official protocol pages, and it's the best place to start, really, if you're looking to just jump in like we're doing right now. So ideally what we're going to look for are yields that are greater than the US Fed interest rates, which is around 4% at the moment, and likely going to go up. So we're trying to aim for returns that are better than that, because if the returns are worse than that, then why not just go for short-term treasuries? Alright, so first things first, we look at just the top 15 protocols from DeFi Llama on the Polygon chain. And then you can see here, we have different ones like that you'd know, Aave, QuickSwap, Balancer, etc. And on this list, just to run through it super quick, I've just went through, so first I pulled up all 15 of them, went to each one individually, went to all their different product offerings on the Polygon chain, looked at the different interest rates they offer, what kind of liquidity providing you can do, what kind of estimated returns that they're giving, and this is effectively the best interest rates on those different protocols. So for Aave, it's 2%, and I think it was DAI. I want to say it was DAI, which is like a stable coin lending. And then you have QuickSwap, Balancer, Uniswap. They're all different decentralized exchanges. And for stable coin liquidity providing, they're all less than 1%. So absolute trash, really terrible. Stablecoin liquidity providing is just has always been bad, and it probably will always be bad. So just stay away from those. There's really no point unless you can do incentives and reward mining and farming. It's kind of an exploitative strategy, which some of those do have, as I'll talk about in a moment. And then we have Beefy, which is one of the top protocols, but really Beefy is just an aggregator. It just connects to the other ones. So this 5-9% you'll find in the different other protocols, and probably in most cases you're better off just going to those other protocols. Then we have Tetu, which gives about a 5%. Curve, again, another decentralized exchange, absolute trash, less than 1%. Gamma is an interesting one. So Gamma offers on stablecoin pairs 1 to 25% APR. Now, this isn't pure, returns. This isn't actual generated from the fees. This is incentives. So it is a automated liquidity provider. So you go on one of these Uni V3s, put up your stablecoins into one of those, it will manage your position, and then by doing that and staking on Gamma, they will give you some incentive, so up to 25% on some stablecoins, which is pretty good. Stargate, again, you get about 5%. I think that's real yield. Sushi, another decentralized exchange, you get 0%, but with incentives, some of those you can get up to 13%. Kyber Swap, another one, that's another one that's incentive mining, and the same with Mesh Swap, we have also incentive mining, that's in brackets. So the real yield is 5%, 30% is what you would get if you were purely going for the rewards, which in most cases, when you're liquidity providing, that's what you're getting. All right, then we look at specifically the lending protocols on Polygon. Here you have a couple more options. The only issue with this is, as you see, really there's only 4 options, and the rest of them either have no lending offering, no liquidity, or just no TVL. Like they're just, you basically just ignore those for now. So as you see, lending is terrible, except for DeForce. Now on DeForce, you can see that it's 2% yield. That's real yield. So that's from the actual lending interest. And then they give possibly another 2% from incentives, which is nice because if you have a lending protocol that offers incentives, you can often do looping or different types of arbitrage to kind of exploit the system and trying to mine as much of those incentives as possible. So the real yield, if you do specific strategies and you're willing to take certain risks, can be much higher, can be up to about 20% if you take a lot of leverage. And then we just check the other. So this is again DeFi Llama. These are different headings that you can check, different categories. So this one is just yield. So it means just other things that can possibly generate yield, other protocols. And so you look through these. Again, most of them aren't great. Yeah, the top ones have only about 5%. And then when you start getting some of these weird ones like Woofy Earn, Moon Farm, Kogi Farm, and Davos, and some of these kind of alternative, experimental protocols, they start offering a bit more through incentives. So these are certain things to possibly keep an eye on. And so in the end, here's the shortlist. Here is the list of protocols, these are not ones to invest in, mind you. This just means these are ones to look into. These are ones that you need further research, both the actual protocol itself, the code, and the strategies. So we have Gamma Swap, which is the automated liquidity providing, as I said. You have Sushi Swap, which is a reputable DEX. Kyber Swap, not reputable DEX. Mesh Swap, another not reputable DEX. DeForce is a not reputable lending protocol. Impermax is a kind of leveraged, it allows leveraged liquidity providing and lending, which is actually quite a nice protocol. Taro is a fork of it, which is also a very nice protocol because it allows hedging during liquidity providing, so you can get delta neutral type gains through liquidity providing. And again, the other ones, Fractal Protocol is experimental protocol. Synapse is I think a stablecoin exchange. I can't remember. I did this like a week or two ago, so I actually can't really remember some of these, what exactly they did, but these are the quoted APRs. Now, quoted APRs doesn't mean this is the actual APR you're going to get. In some cases you get more, such as with Mesh Swap and some of these other ones when you can exploit incentives, but in most cases you're going to get less, and this is because these APRs don't take into account the risk of investing in the first place. So even just simply saying, like, if the risk is, I don't know, there's a 5% chance that you're going to get hacked on, say, Synapse, then your net could be 5%, right? There's a 5% net APR that you're going to get. But if you consider that in terms of the portfolio, or maybe if it's aligned with different other risk assets, then potentially you can get more or less in total in a portfolio kind of sense. So that's Polygon. Not the best returns, but you know, the shortlist is reasonably sized. So hopefully in the future I'll maybe go into a few of these specific protocols, or maybe when I do some of the other chains that we have crossover protocols. So you know, that's less research that needs to be done. But again, if you want to do this yourself, I would suggest doing it in 3 stages, and depending on what your strongest stage is, you can focus on it. So 1, just learning what the protocol is, how it works. 2, the strategy, the risks, and the analysis itself of the investment position and how it works in a portfolio. And that's a lot of what I teach and what I make videos about. So you know, if you want to learn more about that, stay tuned. And then the 3rd section of risk management and investigation is the code base and the developers. So thanks for watching. Like and subscribe, and I'll catch you later for some more videos.